You have seen thousands of candles, but have you ever thought about what really happens inside them? This is a candle range theory, just a simple way to look at candles a bit differently. In this video, I will explain it step by step, give you easy strategy, and also I develop free indicators that find this concept and make trading it simple. Let's do it! Okay, let's start with the core idea. Candle range theory is based on the liquidity rate of the previous candle range and then run to the next liquidity level. Like if price grabs the liquidity of previous candle's high, then we expect the price to run towards the low of candle range and vice versa. So that's the main term. Now let's take a look at psychology. It explains why candles move the way they do. Every candlestick on a high time frame represents a complete range on the lower time frames. And if you understand what type of candle is forming next, bullish or bearish, you can predict potential movement on the lower time frame. Typically, the first candle can either grab liquidity, balance the market, or form a discount zone. Essentially, it sets up a specific move before a potential reversal. The second candle usually forms the entry setup. It takes liquidity as the high or low of the previous candle, but closes within the range, and it may even form a change state of delivery on the lower time frame. The third candle is generally the reversal candle. During this candle, a change state of delivery can also form, potentially pushing price toward the opposite liquidity. However, the move doesn't always complete in a single candle. Sometimes it can take several candles to reach the target. Let's look at this example. The first candle creates an upward move, balancing the market structure. The second candle sweeps above the previous candle's high, but closes below the range. That's a strong signal. Buyers tried to break the level, but sellers proved stronger. This means the third candle could form a potential reversal. To confirm this scenario, we wait for signal. CSD plus SMT divergence. We can see that gold made a new high and formed a CSD, while silver didn't. That's strong confirmation of possible reversal. After CSD, we can consider entering a trade. Stop loss can be placed above the high and take profit at the CRT low. And one important factor to consider is the zone of interest, because it can significantly increase your accuracy. Trading CRT anywhere or at any time can reduce your chances of profitable move. That's why it's crucial to take these zones of interest into account. This could be a fair volume gap, an order block, or other key levels. Most traders focus on these zones, and ideally the order should be opened within the active session. Let's break down this example. At the bottom there is a fair volume gap. You can see that the first candle creates a move that approaches the balance zone. The second candle tests this zone and forms a strong reaction by closing within the range, indicating that the third candle could be potential a reversal, and third candle create a reversal. Of course, the price doesn't always reverse in a single candle. It can take several, but this is all probability. In the second example, let's focus on CRT. At the bottom there is order block. The first candle pushed the price into the order block area. The second candle forms the entry setup, grabbing liquidity and closed within the range. And after that, the price begins to reverse, following the movement. Now that we have gone through all the theory, the only thing left is to understand how to actually trade it. I can show you a simple strategy that you can start using right away, but of course, with practice you will be able to achieve much more and maybe even develop your own better. The first thing we start with is timeframes. Basically, we're looking for the candle range theory pattern on a higher time frame. Then we switch to a lower time frame to look for confirmation for entry. For example, if you spot the candle range theory on the daily time frame, then you go down to 30-minute time frame to look for your setup. The same logic applies to other time frames. You might look for candle range theory on the 4-hour chart and the entry setup on the 15-minute time frame. All of these time frames are shown right here. Then, to improve accuracy, you can determine the possible bias. I will show you a simple and standard way to do that. It can help, but keep in mind, it's not most high probability method. The first scenario is when the candle closes above the previous daily high. This can indicate that the next candle might also be bullish. The same goes for a bearish situation. If the candle closes below the previous daily low, it suggests that the next candle could be bearish too. The second scenario is when the price tries to break the previous daily high, but closing below the range. That shows buyers try to push the price higher, but sellers were stronger. Since the candle closed below the previous daily high, it suggests that sellers are in control, and the buyers might be bearish. The same logic applies to other way around. If the price tries to break the previous daily low, but closes above the range, it shows that the buyers were stronger, and the next candle might be bullish. And finally, the third scenario, when the candle doesn't touch either previous daily high or previous daily low. In that case, price stays within the range, and this indicates a natural bias, meaning the next day, price can move either up or down. So, let's break down strategy step by step. First, we need to determine the bias, daily or weekly. This step is optional, but it helps to understand the overall market direction if you understand it good. Second, we identify the key levels. That could be an order block, an imbalance area, or maybe an inverted fair volume gap. And the third is to open an order during sessions, when the volatility in the market is good. Mostly it's London or New York session. Let's break down this example. We can notice that during the New York session, on the hourly time frame, price attempted to take out the previous candle high, but it closed below that range. If we look to the left, there is an imbalance area. Price completely filled it and gave us a clear reaction. That indicates a formation of a candle range model. We can also see another imbalance and liquidity below, around the candle range low. This suggests a potential move to downside. When we switch to lower time frame, we want to see a confirmation. For example, SMT divergence plus market structure shift or change state of delivery. There is also a trigger around the hourly imbalance zone, and once we get the confirmations, that's where we open the order. And the best part of this video, I have created an indicator that shows this candle range theory and also displays the daily and weekly bias. First, how does it determine the daily and weekly bias? It follows this logic. If the candle closes above the previous daily high, that's a bullish scenario. If it tries to break the previous daily high but closes below, it indicates a bearish scenario. And if it closes inside the range, that means a neutral bias. How it identifies candle range theory itself? The indicator detects candles that try to break the previous candle's high or low, but close it inside the range. Once it finds that kind of candle, it marks CRT high and CRT low levels. It also includes an alert system. So for example, when a new candle range pattern is formed, you can get a notification directly on your phone. I will leave you a link to this indicator in the description. So, how you can actually use it? You can apply it using the strategy I just explained, or you can combine it with the daily and weekly bias. For instance, when both the daily and weekly bias point in the same direction, you should look for a pattern that aligns with that direction. Let's look at this example. On the left, we can see a daily imbalance, and we can also notice how the price formed a candle range pattern. It tried to break the previous candle high, but closed it inside the range. Since the daily candle also closed inside the range, that gives us a bearish bias. And if we check the weekly and daily bias, it's bearish too. So we can expect that the next day, price might move down toward the candle range low. And we can also see a volume imbalance below, which might act as a magnet for price. Now let's move to a lower time frame to find our entry model. We are currently in the London session, so we are looking for an entry setup within this session. First of all, we can notice a hidden SMT divergence. If we look at this open level, we can see that on the Euro USD, the level was broken, but on GBP USD, it wasn't. As you can see, there was only a wick, meaning the candle didn't close above that level, and that confirms a hidden SMT divergence. Later, we get an interesting setup. A candle range pattern forms on a 30-minute time frame, plus the SMT divergence is still there. As you can see, the high gets taken on Euro USD, but it didn't on GBP USD. After the structure break, we can open a short position targeting the candle range low. So it's nice. Okay, now let's break down this example. We can notice a 4-hour imbalance below. We also have a candle range pattern. It tried to break the previous candle range low, but closed it above the range. And at the same time, it filled the imbalance. This shows a strong reaction from buyers. If we also pay attention to the daily and weekly bias, both are showing bullish, which give us a strong confirmation to look for a long entry. When we move to a lower time frame, we can see that on the gold, the swing wasn't taken out, but on silver it was. Then we wait for a break of structure, and after the breakout, we can open a long position. The stop loss can be placed below the low, and take profit at the candle range high. So it's nice setup. Let's move to another. Okay, now let's take a look for a last example on American index. We can see that a candle range pattern has formed, and at the same time liquidity above the buy side liquidity was taken. If we look at Nasdaq, we can notice an SMT divergence. Nasdaq slightly takes the swing high. It's not very obvious, but it does break it. However, S&P doesn't take that same swing high, and that gives us a clear SMT divergence. Now we move to a lower time frame to look for confirmation. By the way, I also have another indicator that helps identify change in state of delivery, and it's if it's hard for you to spot it manually, you can use it. It's called CSD plus fractals by Milana Trades. As you can see, once I turn it on, we can spot that CSD has formed right there. And from this point, we can look to open a position. The stop loss goes above the high, and the take profit below the candle range low. Okay, it's nice. Alright, that's the end of this video. Make sure to check the description and you will find all my socials, pre-indicators and a link to a Telegram channel with traders community. Keep learning, stay consistent, trust the process, and I will see you in the next video.